Good morning, good afternoon, good evening, everyone, and welcome to today's presentation on building a robust Forex trading strategy with intermarket analysis. My name is Ali Mortazavi, and I'm the head of education at Orante. I'm excited to guide you through today's session where we'll explore how to integrate intermarket analysis into your Forex trading strategies. Before we get started, I just want to make sure everyone can see and hear the presentation clearly. So please let me know in the chat if you're experiencing any issues with the audio visuals. Once we confirm everything is working well, we will dive right into today's content. Thank you. Okay, I'm getting a lot of confirmation from guys. Thank you so much. Okay, it seems everything is working smoothly. Great. Okay, it's worth to mention that this webinar is brought to you by Orante, which is an online broker committed to providing top-tier services and building lasting and trusting relationships with clients and partners. But before we begin, please note that the contents of this webinar should not be construed as investment advice of any kind. The strategies and information provided are for educational purposes only and should not be considered as a recommendation to trade. Because trading CFDs carries a high level of risk and it's possible to lose all your invested capital. So please ensure you understand the risks involved and seek an independent advice if necessary. Okay. Now, in today's session, we will demonstrate three core strategies that you can implement in your trading. First is correlated market analysis strategy on leveraging commodity and currency correlations. And then we take a look at the cross-market confirmation kind of strategy, which is using a stock indices to confirm Forex trades. And we will also take a step at for yield spread differential in Forex, understanding bond yields and their impact on currency pairs, especially on major currency pairs. And once everything is good on your end, we'll jump right into the first strategy. All good? Perfect. So let's get started. Correlated market analysis helps us leverage the relationship between the various markets to enhance our trading decision. For example, if you're trading currency pairs like USD CAD or AUD USD, knowing the trends in commodities such as oil or gold can provide an edge. If oil prices rise, for example, commodity currencies like CAD or Canadian dollar tend to follow, and we can use this correlation to enter trades as optimal points. If you remember our previous webinars, we let's say introduced some of the commodity related currencies, and among them we have Canadian dollar and Australian dollar, which are very sensitive to commodity prices like oil or like some let's say other hard commodities, some hard commodities like for example steel or iron ore. Okay. When entering a trade, we want to look for strong correlation signals between the currency and its correlated commodity. So in this example, if oil is in a clear uptrend and let's say the USD CAD is trading near a strong resistance level, the strength of oil could help push Canadian dollar higher, which usually result in weakening USD CAD. Yeah, so you can combine this with technical indicators like moving averages or Bollinger Bands to confirm the trend. Also, we can find a clue for exit strategy using the correlated market analysis. Exiting a trade at the right time is just as important as entering at the right time. We use correlated markets to help identify when a trend might be weakening. If you've entered a long, a short USD CAD trade based on oil's strength, or let's say a long AUD USD trade based on the oil's strength again, and now oil prices begin to decline or show volatility, this is an early warning to consider exiting your position before the currency follows the downward move. So keeping an eye on correlated markets can help protect your profits. So in that case, we are going to take a look at a strategy by using the correlation between the Brent the Brent oil and the USD CAD. So let's analyze the screenshot here, which is our first practical example. In the context of correlated market analysis for entry and exit, particularly focusing on oil Brent and its correlation with USD CAD. You know, the USD CAD is also correlated with the WTI, which is coming from the New York benchmark. However, let's take a look at these charts here. Brent crude oil on the left, we have this chart here, and you see the Brent chart shows an uptrend supported by an ascending trend line, as you see, with price bouncing off support near 73.50 and testing resistance around 74 point, let's say 50. This is the price is somewhere here, but we see this rebounds from this strong, let's say, support level. And if you look at the Bollinger Bands here, the price is trading near the middle of the Bollinger Band range, indicating potential for further upside as long as it stays within the uptrend. And also the key support is 73.50 seems to be holding, which could provide a bullish outlook for oil right here, because we have the confluence of this strong or significant support levels here. One is our uptrend line, and the other one is this key price level here, 73.50. And on the right chart, we have USD CAD. The trend of the USD CAD has been is almost in a range. Yeah, you see the USD CAD has been trading lower after failing to break resistance at 1.3581 and has now dropped below 1.3555, indicating a weakening USD against CAD. But we see USD CAD is highly correlated with the price of oil because the Canadian economy is heavily reliant on oil exports. When oil prices rise, the CAD tends to strengthen, pushing USD CAD lower. So the pair is trading below its moving averages, signaling further downside potential, with support level indicated by Fibonacci projections down to 1.3527. These are the 1.27%, let's say, extension from this high swing here we see, and the next one is 1.16618%, and the next one is a 200%, or the same distance as we have from this resistance level here, and the next one is 2.618%. Okay, so next one we need to look is correlated market analysis. To find our entry signal, the Brent oil chart shows oil holding its uptrend, which should strengthen the CAD. In turn, this correlates with a weakening USD CAD. So a strong entry point would be to short USD CAD, especially as it breaks key support level around 1.3555 and heads toward the next support around 1.3537. So it it can be our entry point here. You would monitor Brent oil's performance to guide your exit as well. If Brent oil starts reversing from its uptrend and breaks below $73.50 support, it could signal weakening CAD strength. So this could be an early warning to exit your short position in USD CAD. So you see, based on the correlation between Brent oil and Canadian dollar, consider shorting USD CAD as long as Brent continues its uptrend. The break below 1.355 is an entry signal to ride the short position down to the next support levels. So you can project your targets using Fibonacci extension. And keep an eye on Brent oil, or let's say if you want to use the correlated market analysis for exit as well, if it breaks below its 73.50, as you see here, it means is now getting to a new downtrend. So it would be a sign to exit your short USD CAD position before the CAD weakens. So this analysis shows how oil's uptrend signals a strength in the Canadian dollar, making USD CAD short a high probability trade. The next one, the next strategy we are going to demonstrate here is the cross-market confirmation, which is leveraging the correlation between the stock indices and Forex pairs to confirm trends. For example, when global equity markets are bullish, risk-sensitive currencies like AUD or NZD are or JPY, let's say, tend to strengthen. And this intermarket relationship gives traders an additional confirmation tool when making decisions about Forex trades. As an example, we know the S&P 500 is a key barometer of global risk sentiment. So when it's rising, it usually signals that investors are willing to take more risk, which tends to support risk-sensitive currencies like AUD or NZD. On the flip side, if the S&P 500 turns bearish, we may see a flight to safety, causing safe haven currencies like JPY to appreciate. And when the on the other side, when we see S&P 500 is breaking out to new highs, it's a sign that risk appetite is growing. So if at the same time a risk-sensitive currency pair like AUD/JPY is trading near a resistance or breakout level, we have a strong signal for a long position. The alignment of trends across these markets provides higher confidence in the trade. So this is how we can use the, let's say, correlation or this cross-market confirmation to be more confident about our trade. We can also use it for our exit signals that can often be found by monitoring the performance of equity markets. For example, if excuse me, I think my presentation is not sync with my voice. Let me make sure if everyone can see my presentation very well. Okay, I appreciate if you can send a confirmation chat box, so we'll be confident to continue this webinar. Okay, good. So let me repeat it again. So, as you see here, the correlation between the stock indices and FX is usually found in risk-sensitive currencies and the main stock, let's say, indices. For the risk-sensitive currencies, we have AUD and NZD and JPY, which tend to react to shifting global risk sentiment. And as a barometer of risk, we use S&P 500. The strong S&P 500 index reflects a risk-on environment where investors favor higher yielding, riskier assets such as AUD, which is in correlation with let's say commodity markets. And we know in a risk-off sentiment, or in a risk-on, let's say, environment, as we have in this example, we know the commodity prices tend to increase in demand. And conversely, a bearish S&P 500 indicates a risk-off environment for safe haven currencies like JPY may strengthen. So this is a good way to consider our further confirmation for our exit or entry signals. And to identify high probability entry points, we can look for global equity indices like the S&P 500 breaking in new highs or confirming a bullish trend, then check for risk-sensitive currency pairs. We know that a bullish breakout in both markets signals a high probability trade opportunity for going long. And on the other side, exit signals can often be found by monitoring the performance of equity markets as well. If the S&P 500, for example, starts to show signs of weakness or enters a downtrend, this risk-off sentiment can quickly spread to risk-sensitive currencies like AUD or NZD. At this point, you should consider closing your positions to avoid losses from potential reversal in the currency pair. Now, we have an example here. Don't worry, I'm going to demonstrate it on the chart to see how it works. Let's analyze this chart here in the context of cross-market confirmation, focusing on the relationship between the stock indices, in this case, the US 500 index that you see on the left side, and a currency pair like AUD USD that you see on the right side. So let's take a look at the trend and the other, let's say, features of the US 500 index here. You see, the US 500 index is in an uptrend, having recently broken above a key resistance level, now labeled as a broken resistance. And this breakout indicates bullish momentum in the stock market. As a technical setup, I would say the index is above both the 20-day simple moving average, which is a middle band of the Bollinger Bands, and 100-day weighted moving average, or WMA, which confirms the strength of the uptrend. The Bollinger Bands show that prices near the upper band, suggesting a strong momentum, but also signaling potential overbought condition in the short term. However, when we see the widening outer bands, we can make sure that after breaking this resistance level, the positive momentum is gaining. So it means we can expect the index to move maybe higher. But let's take a look at the right chart here. We have AUD USD. The trend is also in an uptrend here, with the price moving higher after bouncing off the support level at 0.6620 and more recently 0.6722. Let's take a look at a technical setup here. The currency pair is trading above its moving averages, WMA 34 and WMA 100, confirming bullish strength in line with the S&P 500's rise. So Fibonacci extensions suggest potential offer targets around 0.6878, as you see, in 0.6907 and 0.6948, which could align with further strength in the stock market. And the RSI on the other side, we have it here down here, is moving into the higher range above 60. Yep, as you see. But is not yet overbought, suggesting there is room for further upward momentum. So how we gonna analyze the cross-market confirmation here. Uh, AUD/USD is often seen as a risk-sensitive currency pair, meaning it tends to rise when global stock markets are strong and investors are in a risk-on sentiment. The Australian economy is heavily reliant on commodities and global trade, which often links its currency to broader market risk appetite. In this case, the S&P 500 breaking resistance and continuing its uptrend suggests a continuation of risk-on sentiment globally, which would likely support further gains in AUD/USD. Both charts confirm each other's bullish momentum, providing a cross-market confirmation signal. Okay, given that both the US 500 and AUD/USD are trending upward, a trader could look to enter a long position in AUD/USD as long as the S&P 500 maintains its strength above the broken resistance level around 5,680, and AUD/USD continues holding above 0.6722 support level. The alignment of these two markets suggests that the AUD is likely to benefit from continued optimism in global equity markets. Now, if the US 500 index begins to show signs of weakening, such as failing to hold above its broken resistance level or reversing from its current uptrend, this could signal a potential exit point for AUD/USD, as a weakening stock market often corresponds with a drop in risk-sensitive currencies like AUD. Likewise, if AUD/USD fails to break above 0.6878 first Fibonacci extension, as we have here the first level, or reverses below its recent support level, this could be a signal to exit long position. In conclusion, in the context of cross-market confirmation, the charts show that both the S&P 500 and AUD/USD are confirming each other's bullish trends. So the uptrend in the S&P 500 reflects a risk-on sentiment that is likely to support further strength in AUD/USD. As long as the stock indices or stock index here, we have S&P 500 remains bullish, AUD/USD has the potential to reach its Fibonacci extension targets that we made on the chart, and making this a high probability long trade. However, any sign of reversal in the stock index would warrant caution and serve as an early exit signal for the AUD/USD trade. So far, so good, guys? Okay, that's great. Now let's take a look at the third strategy that we are going to discuss today, the yield spread differential, which is the difference between bond yields of two countries like the US and the Eurozone. And this is crucial because a wide yield spread means that investors see better returns in one country over another, attracting more capital and strengthening that country's currency. In this case, we have Euro USD, and we'll focus on the Euro 10-year government bond yield and US 10-year treasury yield. When the US yield rises compared to the Eurozone yield, the USD typically strengthens against the Euro, creating opportunities for trades. So for entry signals, traders can short Euro USD when the yield spread widens in the favor of the euro bond, typically after a retracement to a resistance level in the pair. And on the exit side, traders should monitor when the yield spread narrows. The signals of potential, it means something like a convergence between the bond yields when we have, for example, a higher yield in the US 10 bond, treasury bond, and compared to the euro bond. So this signals a potential reversal in the trade, prompting an exit to protect profits. Setting a stop loss around recent resistance or using the middle Bollinger Band level can help manage risk in these trades. By keeping an eye on both yields, yes, uh, excuse me for interruption. Uh, I was saying we need also to use the stop loss all the time. And to that, we can consider the middle Bollinger Band level that can help manage risk in these trades. And by keeping an eye on bond yields and yield spreads, uh, traders can time their entries and exit more effectively in the Forex market, particularly with pair like Euro USD, and we will get to that shortly. But before that, for the yield spread differential strategy using bond yield to forecast Forex movements, let's say long-term bonds typically work better than short-term bonds here, and here is why. Because first, long-term yields like the 10-year or even 30-year bonds are more sensitive to macroeconomic factors such as growth expectations, inflation trends, and central bank policies over a longer time horizon. And these are the same factors that influence currency strength, especially during the event announcements. Um, On the other side, the short-term yields, like 2-year bonds, are often more directly influenced by immediate central bank policy actions and interest rate expectations, which can fluctuate more frequently, making them less reliable for forecasting long-term trends in Forex. So, uh, we prefer long-term bonds because of this first reason. The second is that long-term bonds tend to show more stable movements compared to short-term bonds. Forex traders often use the yield spread between long-term bonds because the moves reflect deeper economic trends that align with sustained currency movement. And short-term yields are more volatile and can be influenced by short-term liquidity issues or let's say short-term shifts in monetary policy, which may not always translate into sustained currency trends. The third reason here is that long-term yields, yield spreads, and forex correlation usually confirm each other in a better way. For example, the yield spread between US 10-year Treasury bonds and Eurozone 10-year bonds gives traders a good indication of long-term capital flows and relative economic outlooks between the two regions. When the spread widens, favoring US bonds, for example, US tends to appreciate against Euro as investors seek higher returns. So if you use short-term bonds like 2-year or 5-year, they are more likely to react to immediate central bank decisions, as I mentioned, like rate hikes or cuts, which can cause a whipsaw effects on currency pairs, making the strategy less predictable. And the fourth reason is fewer false signals. Long-term bond yields are less prone to sudden short-term shifts that could give false signals. The 10-year EL spread between the US and Eurozone is more likely to indicate a sustained trend in Forex, giving you confidence in holding your position longer. So short-term bonds could react quickly to temporary shocks like unexpected inflation data or central bank comments, leading to more frequent false signals in the forex market. So for this kind of strategy, long-term bond yields like 10-year bonds are generally more effective. They offer more reliable signals that align with broader economic cycles, making them a better indicator for sustained movements in currency pair like Euro USD. And this makes the 10-year yield spread a preferred tool for forecasting long-term forex trends. Now let's break down this strategy where you see three charts we have here in 4-hour time frame. The left panel is Euro USD, and the middle one is the Euro 10-year government bond yield. And the left panel, or sorry, the right panel is the US 10-year government bond yield. So the Euro USD pair has been trending downward recently, moving from around 1.1140 to the 1.1020 region, as you see here in the chart. Yep. Okay, the pair is trending near the lower Bollinger Band, indicating potential oversold condition, but the downtrend is still intact. And this decline in Euro USD aligns with the broader macro context, where the yields between the US and the Eurozone are diverging. Let's take a closer look at the Euro 10-year government bond yields. As you see here, this Euro 10-year bond yield is sharply declining, and it moved from around 98 at the start of September uh, down to around 90. And this steep drop signals lower returns for investors in Eurozone bonds, making the euro less attractive to foreign investors. As bond yields fall, we say foreign capital is likely to move toward higher yielding assets. In this case, you have the US 10-year Treasury. So the US 10-year Treasury, or US 10, remains relatively stable, fluctuating between 101.6 and 102.3. And this stability means that the US offers comparatively more attractive yields, making the USD more attractive to investors. And with US bond yields holding firm and Eurozone yields falling, the yield spread differential between these two is widening in overall in favor of the USD, for sure. Yeah, because it's rising and the other is declining. So the chart clearly show the widening yield spread between the US and Eurozone bonds as the Euro 10-year bond yields continue to fall and the US 10-year bond yields stay stable or rise somehow. And this increases the relative attractiveness of USD over the euro. This widening spread is putting downward pressure on euro USD, which is why the currency pair is trending lower. So the downtrend in Euro USD and the widening yield differential suggested entering a short position on Euro USD could be a solid strategy here. And you could consider entering on a retracement near the middle Bollinger Band, for example, somewhere here. Or a resistance at 1.105 between 1.105 and 1.11 with a target near recent low of 1.10 or lower maybe. Also, if the Euro 10-year yield starts rising or the US 10-year yield begins to decline sharply, this would suggest the yield spread is narrowing, so which could prompt an exit from your short position here. In conclusion, the chart you're seeing here shows a clear divergence in bond yields between the Eurozone and the US. The falling Euro 10-year yields makes Euro less attractive, while the stable US 10-year yields strengthens USD. And this widening yield spread differential is leading to the decline in Euro USD, presenting an opportunity for shorting the currency pair. So this is how you can somehow, let's say, use or apply yield spread differential on your chart. In that case, you can, for example, compare the EU 10-year government bond to the Britain, let's say, 10-year bonds, or the Japanese 10-year bonds yield. And if you have let's say related currency pair here. So as you see, we covered all these three strategies, but here's some point I would like to get your attention on those, because when trading with correlated market analysis, while the price movements of correlated assets can offer valuable signals, it's essential to consider a range of additional factors to make well-informed trading decisions. And here are some critical elements to keep in mind. First, uh, central bank policies and interest rates. Central bank interest rate decisions and policy outlooks can significantly affect currency movements, sometimes more than commodity correlations. Uh, so, for example, before we get to the geopolitical event, let me explain it fully. Even if oil prices are rising, a more hawkish stance from the Federal Reserve compared to the Bank of Canada, for example, could support the USD against CAD, temporarily weakening the correlation. And also, the expectations of future interest rate hikes or cuts, often signaled in speeches or statements from the Federal Reserve officials or the central bank officials, can shift capital flows and impact currency pairs independent of commodity prices. The next, so in that case, you have to consider the effects of central bank policies and interest rates for sure. And the next one is geopolitical events and risks. Let's say events like OPEC decisions, geopolitical conflicts, or sanctions on major oil producing countries can sharply affect oil prices, indirectly impacting oil sensitive currencies like Canadian dollar or Norwegian krone, and of course the ruble, the Russian ruble. Also, we have, let's say, global trade tensions. Trade wars, sanctions, or tariffs between major economies like the US-China trade war can distort normal market correlations and as risk sentiment dominates capital flows. And also the domestic political issues, elections or policy changes in countries linked to the commodity like oil producing countries can disrupt the typical correlation between commodities and currencies. So when you are using the correlated market analysis, you have to consider these factors because they can have let's say, an adverse impact on the correlation between the currencies, which was usual in this stable time. But maybe because of one of these factors changing sharply, that can make more fluctuations in the market. The next one is considering global risk sentiment. We have two types of environments, risk on and risk off. Okay, so in risk on environments where investors are willing to take more risks, commodity currencies like CAD, AUD, and NZD tend to appreciate as demand for commodities rises. On the other side, we have risk off environments where investors seek safety. Even if oil prices are stable or rising, safe haven currencies like USD, JPY, and CHF may strengthen due to global capital flight toward safe assets. So we have to take it in mind that tracking some volatility indices can be very helpful, like the VIX. That can provide additional context on whether market participants are leaning, let's say, toward risk taking, favorable for commodity currencies, or risk aversion. We can add to that the seasonality and supply demand imbalances in commodities as well, because commodities like oil and natural gas have seasonal price patterns, higher demand in winter for natural gas, for example. Understanding these seasonal effects helps avoid misinterpreting short-term moves in commodity prices as longer-term trends. And also the supply constraints is another important factor to consider, because changes in commodity supply, such as production cuts from OPEC, disruptions due to natural disasters, or technological advancements, can shift the demand supply balance and affects commodity prices. And this can either strengthen or weaken correlations between the commodity and related currencies. The next one, I can mention macroeconomic data releases that we know all key data like GDP growth, inflation, unemployment rates, and let's say trade balances can significantly influence both commodity prices and currencies. A strong, for example, Canadian dollar or a weak USD correlation driven by oil prices might break if the US posts a stronger than expected economic data. Reports such as the US Energy Information Administration crude oil inventories or OPEC output reports, all of them can have a significant short-term effect on both oil prices and Canadian dollars. Similarly, Australian and New Zealand commodity exports affect their respective currencies as well. So uh, this is what we should to keep in mind. The next factor, which is also very important, is correlation strength and time frames. Correlations between currencies and commodities can weaken or strengthen over time, and it's important to regularly check the strength of these correlations using tools like correlation metrics. A correlation above, for example, 0.7 is typically considered strong, but this can change with evolving market conditions. Also, correlation between assets may work well on one time frame but break down on others. For instance, oil prices may correlate with Canadian dollar in daily time frame, but over longer periods, macroeconomic factors might override this. That's why not all commodities have the same weight on a country's currency. For example, Canada is significantly influenced by oil prices, we know, while Australia is more sensitive to iron ore and gold prices. So a commodity may be rising, but if it's not a primary export of the country in question, the currency might not respond as expected. And another important factor is looking at technical analysis. For example, divergence in technical indicators is essential to align technical analysis across both the currency pair and the commodity. If, for example, oil prices are in an uptrend, but USD CAD shows bullish technical divergence, this could indicate that USD CAD might not continue lower despite rising oil prices. Excuse me, sorry. And monitor key technical levels in both commodity and currency pairs. As you saw in our examples, we use confirming technical indicators, because if oil prices hit a strong resistance while CAD is appreciating, this could signal an impending reversal in both oil and USD CAD. So you see, so we need to see one is confirming one technical indicators in one chart is confirming the breakout or rebounds in the other chart. And there is also other currency specific correlations. Certain currencies are driven by multiple factors. For example, Canadian dollar is not only sensitive to oil, but also to US economic performance, as the US is Canada's largest trading partner. So always consider secondary factors that might influence the currency's movement alongside the commodity. So I'm going to wrap up here. I hope you found it insightful for your trading journey. If you have any questions, please let me know. Please write it down through the chat box or question box that we have. and I would be more than happy to answer you. Okay, in conclusion, I would say remember that the knowledge you've gained today can be a valuable addition to your trading toolkit, because by understanding the type of the correlation between the, let's say, a correlated market or correlated assets, you would be better equipped to navigate the complexities of Forex trading and capitalize on opportunities. Thank you once again for being here today. I look forward to seeing you in our next session. Until then, keep practicing, stay informed, and apply what you've learned to enhance your trading strategies. Have a great day and see you next time.